This episode is brought to you by Plaid. Most lenders see the value of cash flow data. The hard part is getting access to it and making sense of it once you do. Plaid makes it easy to access real-time cash flow and behavioral insights in seconds through a familiar experience borrowers already trust. No heavy lift, no added friction. Learn more at plaid.com/FTT. Hello, and welcome back to another episode of Fintech Recap. February is in the books, and so Jason Mikula from Fintech Business Weekly came back, as he always does, to help me recap what happened, and quite a bit happened. Credit scores, stablecoins, prediction markets. Oh my, there was a lot to talk about. Jason and I got a chance to go very deep on some news that I've personally been obsessed with, which is Block's foray into becoming a credit bureau, maybe a credit score competitor to FICO, definitely. We talk about what is happening, what it means, how it jives with our understanding of how lending and credit scores work, which in certain cases does not jive very well. We also talk about a lot of the reporting that Jason has done recently on stablecoins and the rise, or I suppose reemergence, of no KYC cards, oftentimes enabled by or powered by stablecoins. All of it reminds Jason and me a lot of the drama that we've been covering in banking as a service for the last couple of years, which, if you know how that story ends, does not bode particularly well for the space. So we talk about that. And then Jason tempted me into a rant about prediction markets and all the nonsense that is happening there. We even get into a little bit of a philosophical discussion about what's happening to our culture and the meaning of truth and reality. It gets a little existential at times. As always, a delight to speak with Mr. Mikula. I hope you enjoy today's episode, Fintech Recap. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Jason, another month in the books, and you are now in my hemisphere, so I'm delighted to talk to you at what I feel like is the afternoon for both of us. This is weird.
I know. Usually you're drinking coffee and I am wishing I was drinking a beer.
I was going to say, Jason doesn't actually drink a beer on our podcast for the most part, but I can see that like look in your eye at the same time. It's the right time anyway.
But yes, we are time zone aligned, plus or minus.
Yes, this is very true. Jason, how are you?
Doing well. Thankful that I am in a part of Mexico that is not subject to narco-related terrorism and lockdown. So yes. I am safe. Our family, who actually is in Guadalajara and in that region, is also safe.
Good.
So yes. How are you?
It's funny. In our outline, we have this listed as small talk, and I feel like I have actual small talk. You have like real life, like big things. I'm glad everyone is safe. I'm glad to hear that. I'm good. I have nothing to complain about. A little bit of travel happening. We missed you in Salt Lake City, for what it's worth. And
I am wearing a Utah themed sweatshirt because it is actually weirdly quite cold right now.
Really?
So I have my Sundance sweatshirt on to keep warm while we podcast.
Excellent. Well, you should, if you're going to be in this general zone of time that we're all in, you should be channeling that sort of Silicon Valley slopes energy. I will be getting out back on the road again this week and then quite a bit in March, though I think you actually maybe seem to have been making good on your promise to yourself to not travel as much. I'm jealous. That's so impressive, at least not for work, I should say.
There's a downside risk. I may, as I mentioned in our group chat, I may get drawn to an event in a certain city in Tennessee, but
yes.
That's TBD. We'll have to see if I can make the logistics on that work.
Well, there are draws to Tennessee that I won't get into, but I can understand why that one would be
barbecue
for you.
Right?
Barbecue, exactly. That is what I am obliquely referencing as barbecue. So, if maybe our paths will cross at some point in Tennessee or elsewhere. But until then, as always, lots of stuff to talk about, Jason. I will admit to having a little bit of difficulty sorting between like the grab bag of topics we always hit while also finding sort of novel new things to talk about, while also not allowing myself to become distracted by the amount of like nonsense that's just floating around on Twitter on seemingly like a moment by moment basis. So I've sort of sectioned off my brain into like distinct categories, and I'm trying to align that to the outline we have. Does that work for you?
Yeah, I have to say I was really glad as I was frantically typing myself notes about 60 minutes ago to see that you had picked let's say like a classic Jason and Alex topic to start with. And it's like a refreshing palate cleanse from the insanity that you described taking place on Twitter.
Is exactly right. I am all in on this first story. And Jason, I look forward to converting you. So now you will be all in. Because as you say, this is right in your wheelhouse. This is like a classic Alex and Jason topic. This is Block getting into credit scoring. So let me give the nuts and bolts. And then Jason, I have a bunch of different questions that I want to get into with you. So if folks have been reading my newsletter, you'll know the basics here. Block built an internal underwriting model that can be expressed as a score, which is really not that unusual within the wide world of lending. Any sufficiently advanced lender is going to build a underwriting model for itself that will probably look indistinguishable from Magic to less sophisticated lenders, but this is not an uncommon thing to do. All the big banks build their own underwriting models. Large fintech companies for years have been building their own underwriting models, and Block has built its own internal underwriting model. The key distinction with this one is that it is almost entirely based on internal signals that Block has on its customers. So across both Afterpay and Cash App, consumers will do lots of different things, right? They'll get direct deposits in, they'll store money, they'll put money into savings, they'll use their debit card, they'll send money via P2P in Cash App, they'll use Afterpay to get loans to buy stuff. They will now take out short-term, low-dollar installment loans from Cash App and then repay them. So all of that data in the sort of larger Block consumer ecosystem, let's say, then can be analyzed and expressed in the form of a score. I don't know if it's 300 to 850, but let's just say it's sort of roughly in a typical credit scoring range. And Block has been using that for a long time to underwrite consumers for loans. Now, like most sophisticated lenders, Block believes that its underwriting model is the best thing that's ever been created. This, I cannot stress enough, is a very, very common occurrence to happen. It's kind of like asking, do all new parents think that their babies are cute? Like pretty much universally, yes, you're going to think your baby is the cutest baby in the world. And the same thing is true with lenders and their custom underwriting models. They all think that they're the best. However, what most lenders don't do are two things that Block has done recently. One, expose the credit score to customers. So this is very unusual. For the most part, if you are working with like a American Express or a JP Morgan Chase or a Capital One, they will give you access to your FICO score. They will not give you access to the proprietary score that they've built on you themselves. Even if that score might be very different in terms of your likelihood to be approved or declined than the FICO score, they will sort of push off the responsibility of telling a consumer how they consider their credit worthiness onto FICO and use that as sort of a general proxy as opposed to using their own internal model. Block is not doing that. Block is exposing its exact model and score to its users and saying, here's your Cash App score. Here's where you are right now. Here are the main things you are doing within our ecosystem that have contributed to that score. Here's some things you could do differently or better to increase your score. And similar to the way that the FICO score, Vantage score works in that kind of consumer education capacity, Block is now making that available to users in a pilot. And it sounds like soon that will graduate from a pilot to something that's available to all Cash App users. Jason, your Cash App score will probably be terrible because you just use it to investigate and experiment what's happening with the fintech ecosystem. The second thing that Block is doing that is very unusual is they are going to start selling their score to other lenders so that those other lenders can use it to evaluate customers for credit. Jason, my first question for you is, are you familiar with any other lenders that have ever built their own internal score and then sold it to other lenders? I mean, you have a history in this space. Is this something you've seen before?
No, it really isn't. I mean, as you were talking about Cash App Score, I was like reflecting on the different lenders I've worked at, and to your point, all of them had internal scores, sometimes used in conjunction with off-the-shelf scores. So yes. I think at this point, it's probably safe for me to talk about Goldman without them sending their scary lawyers after me, given that they basically exited all of the consumer lending stuff.
Yeah.
But I mean, that was a net new business that didn't have its own first-party data when it launched, right? Yep. And so and big asterisks that I am not a data scientist, so this is like my simplistic dumbing down of what those guys did. But you would have a model that would have so-called hard cuts, or basically heuristics, and that could include FICO and or Vantage. So basically saying we're not going to lend to anybody if they're below whatever 680, and then you would run an internal model. And I want to say at Goldman it was Mars, and the M, I believe, either stood for Marcus or Mosaic, which was the code name for Marcus before Marcus.
Sure. Yeah,
I couldn't tell you what the ARS and that stand for. But that would then be used to sort of further refine things like line assignment and pricing. So like very, very normal for lenders, particularly larger, sophisticated lenders, to have those internal models. I am not aware, to your point, of another example of a company that does lending, surfacing, and then making that score available, even to your point, directly to the consumer who's being scored, and certainly to third-party lenders that are ostensibly competitors.
Yes. It's weird, right? So, I mean, I think that to your point about like use of the FICO score, use of the Vantage score, this is happening at a moment when traditional credit scores, I would say, have never been less reflective of what's actually happening in someone's life financially, and sort of less relied upon than lenders. And that's not to say that lenders don't use the FICO score and the Vantage score. They do all the time in very important and significant ways. However, like if you think about the range of things that a consumer could consider to be factors that are fair to kind of evaluate their credit worthiness, a lot of that's not in the credit file, and a lot of that is not reflected in a FICO score or Vantage score. So obviously, like BNPL is one example. Most of the BNPL providers don't furnish data to the bureaus. Apart from Affirm, I don't know that any of them are really planning to. And that includes Afterpay, by the way, which is owned by Block. And so there's data there that's not included in the credit file. There's also kind of cash flow underwriting and cash flow data. And obviously that's adjacent to the credit file. It's not included in traditional versions of the scores. The credit scoring providers, the traditional ones, have moved in the direction of incorporating cash flow data, but it's not a core part of the score that everybody uses today. So you could look at it and say, well, this is a great time to surface alternative scores to consumers to help them understand their credit worthiness. You could also say one of the reasons why a lot of lenders don't do this, and I'll just use like Chase as an example. Chase, if they wanted to do this, and I don't think they do, and I think they think it's probably kind of crazy, but if they wanted to do this, they would have to stitch together data from every part of their bank in order to have a score that is representative of all the things Alex Johnson does at JP Morgan Chase. And if you've ever been inside a large bank, and Jason, you had, I'm sure, this experience at Goldman, the different lines of business don't play nicely with each other. The systems are not integrated. They don't like to share data. So it would be a monumental undertaking to try to architect, both politically and technically, the ability to stitch together all the data about my relationship and my activities and my transactions and my experiences with JP Morgan Chase into a single data lake that could then be scored with a single number that represents how valuable I am to Chase. It is a credit, I think, to Block that even though they have multiple different parts of their business and they acquired Afterpay and whatever, their sort of internal score stitches together all of that data into one score. So in some senses, I think Block looks at this and goes, the reason no one else has done this is because no one else can do this, but we can do this. And because we have 50 plus million monthly active users, and because we have a significant scale, I think they say that what is it? I have it written down here. It's a pretty large number, like 50% of 18 to 25-year-olds use the Cash App score on a monthly basis, according to Block. So take that number for whatever it's worth. They think we operate at a significant scale and we have all the data stitched together. So we are actually very well positioned to sort of have an authoritative opinion on consumers' credit worthiness just based on the data that we see personally. So, Jason, second question for you. What value do you think this Cash App score would have to other lenders? Because what Block says is very different than I think how other lenders who aren't drinking the, wow, look how great the Cash App score Kool-Aid, I think they might have a slightly different answer. But what's your take on this question?
So this is interesting. The dynamics in the underlying data and then in the scoring are incredibly complicated. And I'm going to lean on you to help me think through them and point out where I'm wrong or where I'm missing things. It's in your JP Morgan Chase example, or let's say any mainstream lender, they are not furnishing that data to the big three bureaus out of the goodness of their heart, or because they love sharing. They're furnishing it because it is essentially a forcing function or a mechanism to encourage. I'll put that in air quotes, to encourage their borrowers to repay, right? You don't repay, you're going to get delinquencies, it's going to hurt your credit score, and then that has all these downstream knock-on impacts. So it's that's sort of a simplistic reduction of why do lenders generally furnish? So looking at somebody like Square and Cash App, and I suppose you could extend this to some of the other BNPL players, particularly the shorter term, pay in 4 format. And you and I have discussed this before. There seems to be an attitude, perhaps not incorrect, that first party data is a competitive advantage, a differentiator that, even setting aside some of the complications of furnishing pay in 4 data to the bureaus, because there are real challenges in the fact that it's biweekly, not monthly, it's short duration, whatever. I think that you and I both are kind of on the same perspective that they're viewing that as a competitive moat. And if you start furnishing that data, if you are Afterpay or if you are Klarna, and you start furnishing that pay in 4 data to the bureaus, it's now available indirectly to all of your competitors. And so you want to hold on to that as a competitive differentiator, and to be perhaps a little bit more cynical in how I talk about it, to sort of lock your consumers in, lock your borrowers into your product, and reduce the ability for them to go and borrow or use a competitor's product. Yeah. Now, something I think is very interesting, specifically with the Cash App example, is their ability to get repayment, presumably to some extent, is contingent on money coming into that account, right? So it's sort of like a right of offset. And it's not just payroll or ACH credits coming into the account. I'm assuming, and please correct me if I'm wrong, I'm assuming they can also offset against peer-to-peer deposits coming into that account in order to repay outstanding balances. So, something that for any lender reduces the risk and thus reduces the reliance on traditional credit bureau data is sort of being first in line for repayment. And we've talked about this also in the context of the so-called no fee overdraft products that are popular with companies like Chime and Current. It's because the borrower is taking money from the place that their paycheck is coming into, or benefits payment or other direct deposits are coming into, that, and they might dispute characterizing it as a loan, but whatever, that loan, that debt, you're first in line to get paid back, and that dramatically reduces the risk. I can tell you that, when I was at LendUp, which, was more than 10 years ago now, figuring out how to time ACH debits to try to be in the front of the line ahead of every other creditor who's going to try to debit that customer's account on a given day was a huge part of the risk strategy and the repayment strategy. And I think that has only become more true over time with the advent of open banking data and the ability to try to understand when is an ACH credit going to hit somebody's account? How do I time an ACH debit to try to make sure I'm in front of the line? Or through the use of, increasingly common use of real-time payment rails for repayment. So RTP, clearinghouse, debit pulls, and what have you. I've now rambled, and I don't know if I've answered your question.
No, it's a great overview, and just to bounce it back to you, because I think you hit on all the key points, right? I mean, there's this tension that exists between a couple different things. One is, okay, like furnishing, you're right. I mean, I always tell people this. No one is getting the deal the credit bureaus got in the 1970s, right? So like if you go to a lender today and you're like, hey, I'd love it if you would incur a lot of expense and a lot of operational work to give me your very valuable first-party proprietary data for free so that I can then sell it back to you and also all of your competitors, no one is going to sign up for that, right? And to the extent that you can convince folks to sign up for that, or in the case of like the very large established lenders to continue to do this, and I can tell you that I know for a fact, large lenders, when they're negotiating with the credit bureaus, companies that have been buying credit files for decades, when they're sitting down and negotiating a new contract, an ace that they have in the hole that they will sometimes not play, but threaten to play is, well, we could just stop furnishing you data, right? So like, if you don't give us a good price, we'll just stop giving you the data. And that is something that they will say. They never do it, but they will say it. So the deal is not like a universally great deal for lenders. As you say, one of the biggest advantages is using it as a carrot or a stick to encourage repayment behavior. And when you look at most fintech lending product innovation, what you see are products that are designed to not be dependent on that, right? Because fintech, for the most part, got its start serving customers that don't have good credit, or in some cases don't have credit files at all. And so they had to figure out ways to appeal to people who needed credit but didn't have good credit scores. So clearly they don't care necessarily about damaging their credit score. And B, to be able to work with customers that don't have any credit whatsoever. And a lot of the things you talked about, like being first in repayment line, if you look at Cash App's loans that they offer, they have some very interesting repayment options built into it where you can just automate, like, hey, pay it out of whatever source of income comes in. Like, they're very accommodating of any way that you want to automate the repayment structure because they sit in the flow of funds so much. That's a huge strategic advantage. Another one that's very simple but important to remember is a lot of these lenders, they just offer small dollar short-term loans, right? And I think about Klarna sometimes as a company that basically goes into a new market, loses a ton of money by giving a small loan to everyone, and then uses that knowledge to sort of sort out goods from bads, right? And so Klarna goes in and says, all right, if every 18-year-old in the US gets $200 from us, that's going to cost us X. We will lose Y because a lot of those people won't pay us back. But at the end of that, we will know who the good 18-year-olds are and who the bad 18-year-olds are. That is a marketing expense. That is a go-to-market expense. That is a risk management expense that we are incurring. We then want to maximize our advantage by having learned that maybe other lenders don't know because these are 18-year-olds who've never had credit before. And we don't feel like sharing that information with other people. And I think if you gave Klarna a truth serum, that's how they would describe why they don't want to give data to the bureaus, as much as those other technical and logistical obstacles exist that you mentioned before. The interesting bit, though, and this ties us back to the Cash App story, is, all right, so you're locking people into your ecosystem, Klarna, and you're not going to share your data. And that's fine. I can understand why, from an incentive perspective, you don't feel like you need to or that you should. The challenge is those 18-year-olds, when they turn 25, need a car. And when they turn 35, they need a mortgage. And they need other forms of credit. And are you going to be the provider that does that? Are you going to get into auto lending and mortgage lending and all these other areas? Because if you're not, then you might arguably have an obligation to make sure that other lenders have access to what you know about that customer so that they can serve that customer too. So if I was to put that argument in front of Jack Dorsey, what he would now say is, well, no. There is a third option that I can now offer. I don't have to give up my data. right? Afterpay has said publicly they're not planning at any time in the near future to furnish data to the credit bureaus. They quietly make it very difficult for users to link their Cash App account via Plaid or other open banking data aggregators. It does not work very well. They don't want to share their data. But, Jason, if you want to apply for an auto loan, we will allow you to take your credit score and your data with your permission to that auto lender, and they can buy that data and that score from us. So we are solving the problem of not locking people into our ecosystem while monetizing our data and our score that we've built and giving consumers complete control. Did I just convince you, Jason? Are you convinced that that is going to be the answer moving forward? And on top of that, let me add one additional question, which is Block has said, based on its own research that it's done, that say we use auto lending as an example, that auto lenders could use the Cash App score to approve 30% more borrowers at identical loss rates compared to traditional methods. So, like, if true, why not? Why wouldn't an auto lender be interested in that?
I struggle to believe that that's true, given what we've already talked about the nature of the loans that Cash App is offering through Cash App Borrow versus the longer duration. I mean, plus auto loans these days are what, like 8 years?
So, they are.
I mean, I hate to come across as like a defender of the credit bureaus because I'm not exactly a huge. I mean, it's easy. Sorry, it's very easy to beat up on the credit bureaus.
Yeah.
For all of the obvious reasons. So I guess I actually will be a weird reverse devil's advocate and somewhat defend the credit bureaus in the sense that
I love it.
If you look at other countries that don't have the kind of coverage. Maybe they don't have bureaus at all, or maybe they have bureaus, but the breadth of coverage, both sort of population-wise and product category-wise, is far lower. A knock-on impact of that often is dramatically less access to credit. And since I am in Mexico right now, I will use it as an example. This stat might be a little bit out of date, but it is the one that is sticking in my head because I remember looking it up when I wrote my book. Yeah. And it was like, the major bureau in Mexico is literally just called El Burro. Go figure. And I want to say that, like, at least until fairly recently, the percent of the population that even had a file on the bureau was like 10 or 20%.
Yeah.
And so, to your point, if you're walking into Santander or BBVA or wherever, and you're applying for, you need to apply for a credit product, you basically don't exist in the same way that we have a smaller thin file, no file problem, like as a percent of population in the US.
Yeah.
The idea that, we're going to sort of quote unquote empower consumers and give them the right to have sort of control or portability over this data. I think that sounds lovely in theory, and it makes a really good talking point on stage at conferences. Yeah. I think in practice, there are a lot of problems with whether or not that's actually workable in practice, right? Yeah. And some of these same challenges also exist in the cash flow space, which you know very well.
Yeah.
As far as like, okay, well, if I'm a consumer and I'm going to go apply for that auto loan, but I get to pick what data I'm sharing rather than sort of a file coming from TransUnion, Equifax, whoever, Teltrac, Clarity, DataX, all the specialty bureaus. Sure. I am logically going to self-select and share data that I believe speaks to my ability to repay that loan. And presumably I am not going to share information I think might undermine the likelihood of me being approved. So definitionally, that's going to be an incomplete picture that auto lender in our hypothetical example is still going to want to go out and find data that they think that user may be opting not to share in order to understand what the true risk is, as opposed to the risk that is sort of the very pretty scrubbed version of that user's, whether it's, transactional history on Cash App, whether it's their borrowing history on Cash App, et cetera. And again, like that same sort of conceptual problem can exist in the cash flow space. If I had 5 or 6 bank accounts, one of them I'm having my payroll go into and I'm using responsibly. Maybe there's another one that I'm using to take sort of short-term loans and I'm overdrawing and I'm not managing responsibly. And again, while it sounds lovely to say, we're going to empower consumers, data portability, self-sovereignty, blah, blah, blah. The reality is, if you're making a credit decision, a lending decision, you want all the data, not just the data that consumer is voluntarily choosing to share, whether or not Block is, charging you for it.
No, I mean, it's very true, right? And I think that it ties into another point, which is just like, what are the rules around this, right? Because as we've been talking about, you are not legally obligated to furnish data to the credit bureaus. At the moment, you are legally obligated. And in fact, the sort of deadlines for this are coming up, even though the CFPB is non-functional at the moment. You are obligated to share open banking data. And I find that really interesting, right? Because like one way of thinking about this could be to say, all right, well, if I'm a lender and let's just say I want to look at Cash App data, well, can't I just go through Plaid and get access to this data? And at the moment, not so much. And even though technically Block would be considered to be a large participant under the open banking rule that's on the books at the moment, where I think the deadline is April 1st for being in compliance with the rule, that's not going to be a real compliance deadline. We're going to have an updated rule that comes out. And I think it's just fascinating because, like, if you really believe in data portability, then it's kind of hard to hold a customer's data hostage in order to sell it to lenders with a score that you've built on top of it. If you don't really believe in data portability and you want to just be a credit bureau, that's fine. But then you have to manage those challenges that you're talking about, right? One of the things that's nice about credit bureaus is, from a lender's perspective, they don't really ask customers permission on stuff, right? And so if you we will furnish data without your consent, and if you apply for a loan, you are sort of de facto giving consent for us to get all the data that the credit bureau has on you. You don't get to pick and choose which things you provide, and as such, you are either invisible because you've opted not to apply for a loan, or if you apply for a loan, we will see everything that you've ever done. There's kind of all or nothing proposition to lending. And that makes lenders feel very safe, right? It doesn't feel like they're being adversely selected. Whereas I think in this particular case, they would. The other thing that's worth just talking about briefly, and Cashflow is a good example of this, is I don't really get how this is going to work, Jason, just to be totally frank about it. The problem with cash flow underwriting is you're asking a customer to connect their account. So you're introducing friction into the digital lending experience. And so generally speaking, even though cash flow data is enormously useful for making credit decisions, even on full file customers who already have a credit file, like it helps you better split out goods from bads, it helps you better price risk. You want the data on everybody. Most lenders today are not putting cash flow data at the beginning of the workflow, right? So when you're designing that digital lending experience, you don't want to say as the first step, hey, link your bank account and any other bank accounts you think we should know about, and just sort of pray that the coverage and connectivity that we get through Plaid or any other data aggregators is going to work today, and that Plaid isn't fighting with your bank and where the connection's not going to work. Like, they don't want to do that, right? They want to do last name, address, and last four of your social. Boom. We can go to any one of the three credit bureaus. We'll have great coverage. We'll have great connectivity. It's a seamless experience. There's no real permissioning step. It just happens behind the scenes. By contrast, what a lot of lenders are doing is looking at adding in like cash flow data as a second look option. So, hey, Jason Mikula, we couldn't approve you for a loan, but if you'd like to connect your bank account, we could look at that data and see if it would allow us to approve you. At that point, as the lender, you're taking much less risk. But here's the thing, Jason. In that scenario, they can say, link your bank account. We don't care who it is. And they just throw up the Plaid screen. You pick your bank account. It brings up the thing to add your credentials, and away you go. According to what Block has described for this, they're not going to enable this through the open banking data aggregators. They are doing it directly. And so literally, like, unless I'm missing something, the experience would be something like in a second look capacity. Hey, we couldn't approve you for a loan. If you'd like to connect your accounts, feel free to do so. Here's where you connect all your other accounts. And here's where you connect Cash App. Or alternatively, they might look at you and go, Jason, you're young, you're cool. Maybe you're part of the 50% of 18 to 25-year-olds who use Cash App. Like, I just don't, there's so much friction in terms of when I think about how this score is going to get integrated into lenders' workflows. I just don't really understand it. And I guess it's possible in the press release they put out, they sort of announced they're looking for distribution partners as well. So maybe this gets built into like a Credit Karma type experience or a NerdWallet type experience. Or I think another option they should be kicking the tires on is maybe they flip this around and embed lenders' loan offers inside Cash App. I don't think that's what they're doing, but that might be a different way of tackling this that would solve some of the user experience issues. But like, I don't know, you don't just step into the ring and compete with credit bureaus and assume like, oh, we'll be able to be used just the same way that any other like data source is being used. These are very finely tuned workflows that lenders are loath to like smash with a hammer and then reassemble.
So something else that I'm very much shocked we've made it this far without mentioning is FCRA. And
yes, I love FCRA, man. Yeah.
In my understanding, which is literally based on reading your newsletters, is basically because Cash App is a first party that would be selling its own data or selling its own score, that FCRA just is not applicable, like, period. Is that right? Am I understanding this right?
Well, so that's the thing is, yes, technically. And I looked it up. I went in and I read FCRA specifically to try to figure out, like, because some lawyers were telling me this, and I was like, get the fuck out of here. There's no way that, like, Block can just be a credit bureau and not be regulated as a credit bureau. That's insane. And yet there is this exemption under FCRA in terms of the definition of a consumer report, aka a credit bureau, if it relates to the transactions and experiences of a consumer with the, I think FCRA's language is like person, but like with the company that's selling the data for the purposes of making a credit decision. So yes, there is a loophole, I guess describe it as. I have no idea what motivated Congress to do this originally. I think it probably had something to do with the idea that if you were a lender that didn't furnish data to the bureaus and you just wanted to use your data to make decisions about what you were going to loan a customer, you didn't want to be regulated as a credit bureau. I'm guessing maybe that's the historical, because that makes sense, right? Like if you're, a retailer or something and you just offer credit to your own customers and you don't furnish data to the bureaus, you could see using your data to make credit decisions and not wanting to be swept under FCRA. That would make sense. I don't think the Congress, and this happens all the time with laws written in the 1970s, I don't think they anticipated the idea that there would be a platform like Block that would emerge that would then basically sort of become a de facto credit bureau. And I mean, Jack Dorsey's been pretty clear about this. There was a article that Ron Shevlin wrote in Forbes about all of this, which I would encourage people to read. It did a good job of outlining some of these questions. And the headline was something like, is Block going to kill the FICO score? Something like that. And Jack Dorsey commented on it. It was like, yes, in his typical fashion. And so like they clearly are aiming at, like, we think we can be a major player in this space. I get the sense they want to generate real revenue from this. Jason, I cannot imagine. And I often think about Director Chopra. Not necessarily fondly, but I think about him a lot. He's a character in my brain. Because when I see what's happening in this current regulatory environment, what I think about is, all right, so 3 years from now, if he has that job again, or if someone like him has that job, would they buy this idea? Would they be like, oh, yeah, sure. That's clearly what this loophole meant. And we're totally cool with Block not being considered a credit bureau, not having to conform to any of the obligations that credit bureaus have, not having to conform with any of like the consumer rights necessarily that consumers get when they're interacting with credit bureaus. And there's a lot of rights associated with consumers dealing with credit bureaus, especially given that Block is like a very large tech company, and Director Chopra was not exactly a huge fan of tech companies getting involved in financial services. I just would imagine that a different regulatory environment would find any way they had to essentially sweep Block under the designation of being a credit bureau. Like if it looks and smells like a credit bureau, it's a credit bureau.
We'll find a way to call it and regulate it as one.
We will find a way. We will find a way. And I would struggle to imagine that's not the case. Now, it's possible that Block knows that. and that Block is totally cool becoming a credit bureau. I find that to be a little strange to consider because, again, the core challenge here is if Block is going to become a credit bureau, then its product needs to be able to work at the beginning of that workflow for lenders and be used as broadly as possible. If it's not going to be used that way, then Block, I wouldn't think, would want to like go through the expense and headache of becoming a regulated credit bureau just to not make that much money from lenders. Like, that's not going to work. So they're in this very weird, like, Schrodinger's cat situation where it's like, is this going to work or is the cat going to be dead? Like, we don't really know. And until they start doing this with lenders, some of these questions I think are sort of up in the air.
I mean, the piece, I guess my last comment on this and my takeaway is going to be the piece that I will be most curious to watch is the distribution and sort of what you've outlined as far as based on how lenders are potentially ingesting this information. How is that integrated into their UX or into that application flow? Because as we're talking about this, like every example I'm thinking of, even apart from the big three bureaus, relies on some sort of centralized intermediary, right? Whether you're talking about EWS, early warning services, check systems. You know, I mentioned some of the names of the quote unquote specialty bureaus that existed in the small dollar space, Clarity, Teltrack, DataX. Like all of these rely, I mean, even if we're talking about cash flow, the connectivity that powers cash flow data, you know, you've got Plaid and MX in a financial services market where you have literally thousands and thousands of lenders. Like those intermediaries or those points of centralization do play a role and do add value. Otherwise, they would not exist. Granted, they do. They also come with big network effects and then moats that go along with that. And then to our point about FCRA, you know, potential consumer harm if there are, you know, errors or disputes or whatnot. I'm struggling to imagine how Cash App can sort of try to do this on essentially like a bilateral basis, as opposed to like this sort of having network distribution through some kind of third party. I like your idea of like, could you do this through a Credit Karma or through a Nerd Wallet? Could you do it, you know, through somebody else who already has scale that is also playing in a very similar place?
Yeah, or even partner. I mean, I'm kind of surprised they didn't at least kick the tires, and maybe they did on like Plaid, you know, or someone in the open banking space. Like they're at least working with lenders to try to get cash flow as an entire concept embedded more deeply into the lending workflow. Like that would be another option they could do. So someone like a Plaid or a Nova Credit or someone like that. But I don't see standalone how they're going to convince lenders. And just to put a fine point on it, that 30% more approvals with no increase in loss rates, like I can just tell you, just channeling the typical sort of established lender, they're going to be like, get the fuck out of here. Like there's no way that you could know that. There's no way, having never done any secured lending, having never done ever any lending above X dollar amount or over X amount of months, there's just no way that we can take that seriously. And while I do think that Cash App data would be additive to lending in the same way that cash flow data is, generally speaking, I think the lift is going to be a lot less and is going to be a lot more incremental in different use cases than they are framing it. And you know, lenders aren't stupid. Like any at-scale lender with an experienced and scarred credit risk team is not going to take that pitch all that well. And so I am very curious, to your point, to see where all of this goes. Jason, now we jump to a different segment in my brain, and I would say this filing cabinet in my brain is like things we can't let go of but are important. What do you have for us? Cash flow data can improve credit decisions, but for many lenders, putting it into practice can feel like a heavy lift. Plaid helps you get started without disrupting your existing workflows. Real-time cash flow and behavioral insights are delivered in seconds through a trusted experience used by about half of US adults. Hello, higher completion rates. That means that you can see new risk signals perform in your credit models, approve more creditworthy borrowers, and spot risk earlier without a heavy integration lift. Start small, learn fast, scale when you're ready. Visit plaid.com/FTT to learn more.
You know, I think I promised a lot of deep sighs this year, and I am I am fulfilling on that.
You are.
The parallels between like BaaS and all of the problems we had in BaaS and what we are now seeing in stablecoin world are just alarmingly close.
Yeah.
You and I will have to brainstorm and think if we can come up with a joke for stablecoins that mirrors Bass Island.
Yes.
For those listeners, if you know, you know.
Yeah.
But I have kind of two things, so I will try not to dwell too long on either one of them. One is the I guess, rebirth of so-called no KYC spending cards, although this time with a particular crypto flavor. Alex, I'm sure you remember some of the classics like Zelf and Lasso, which were TradFi. They did not, as far as I can recall, they did not have a crypto component, and they purported to be these no KYC debit or no KYC spending cards. Zelf was working through Evolve, classically. And Lasso, I believe, if I'm remembering correctly, was using Stripe issuing, which actually might have also been Evolve. I would have to go and check.
Sure. Yeah, at the bottom, yeah.
So about 5 or 6 weeks ago, this topic of no KYC crypto cards really starts like bubbling up on Twitter.
I sent you the trending link. I was like, oh my God, Jason, look at this.
And it's actually a story, a broader story that I've been paying attention to since like last October. And I just not gotten around to fact checking, buttoning it up, bothering all the poor comms people who probably hate me. And so I was like, okay, now feels like the time to sort of sit down and write this story. And basically I had looked at, there are like dozens of these sites, right? I had reviewed maybe half a dozen of them, including testing them. So I'm sure there are SARs filed on me from from all sorts of places due to my interesting transaction activity.
You probably have your own like filing cabinet at FinCEN, but that's a different issue. We'll get back to that at some point.
But really, I mean, these services are interesting because looking at the front-facing websites, and these companies have services have websites, they really ran the gamut from some of them appearing to be, let's say, well-intentioned, if overly ideological and naive. So really like leaning into the sort of crypto cypherpunk ethos of like privacy. I don't want you tracking what I'm doing, self-custody, self-sovereign. I should be able to spend money without the government tracking me. And then some of them were just really explicitly and obviously for crime. My favorite one actually being a service called Bitsika, which actually had what appeared to basically be like an SEO marketing landing page that talked about get your no KYC crypto card for use in Iran, and specifically talked about using it to be able to make transactions, paying for things that you otherwise would be blocked from paying for because you were, in a comprehensively sanctioned jurisdiction. Go figure. But I looked at a couple of these services and spun up cards, tested them. One of them called Pay With Us is pretty representative. I profiled it in the piece. And basically the workflow is, you register for the service. You can use any name, any email address. That's basically it. You fund a wallet. The exact mechanism by which you funded varied. A lot of them used what I'm describing as a crypto payment processor called Cryptomus, which that is a whole separate rabbit hole, which is interesting because it purports to be based in Canada, but actually appears to be based in Uzbekistan. Had the largest ever fine from the Canadian equivalent of FinCEN. I don't have the number in front of me, but it was like $140 million for sanctions evasion, among other things.
Of course.
So you can fund a wallet on these platforms across a number of stablecoins or cryptocurrencies and a number of blockchains. The most popular combination is using Tether on Tron, which if you spend time in that world is basically well known as being like the preferred crime coin on the preferred crime chain. But you could also fund with USDC. You could fund with Bitcoin. Sure. One service I looked at even let you fund by paying in Trump coin, Trump's meme coin.
Excellent.
So there's that.
Yeah.
And then once you sort of funded a base wallet or a base account on these platforms, you could spin up and sort of deposit money onto cards. You could even pick what bin you wanted. So, do you want MasterCard? Do you want Visa? Do you want a US-based bank? Do you want a Hong Kong-based bank? Some of them even let you add the cards to Apple Pay, which I did, and went and bought stuff at Albert Heijn, the Dutch grocery store, using the money I had paid in through these crypto services. I will say, it should be quite obvious that something nefarious is afoot, just given the fee structure of most of these. So typically there was a fairly hefty fee to top up to pay crypto in. It could be, a couple percent. Creating a card, I should put creating in air quotes because it wasn't always clear that you were actually creating a new card versus being pooled with other people who are using the same underlying 16-digit card number, which is interesting. But it could be $25, $50 to create a card. And then there were often per transaction costs as well. Also, a lot of warnings on these sites saying, like, if you get too many decline transactions, we'll kick you off. If you generate too many chargebacks, we'll kick you off. I imagine anyone listening to this understands why they would be giving that warning, aka, processors, banks, program managers look at things like rates of chargebacks, rates of disputes, rates of failed transactions as a potential red flag in their transaction monitoring. Also, restrictions on certain categories of merchants that you weren't supposed to be using these cards at. So looking at like the MCC code of like, okay, are you using this card you spun up to go try to, fund a gambling website or buy gold bars or whatever? Again, trying to limit the likelihood of being detected. This is how I interpreted it. Limit the likelihood of being detected by the various service providers in the chain, powering these cards unbeknownst to them. So the part of this that I personally found the most interesting was what I described as a loophole, the most common loophole that these programs were using, which I'm going to be honest, I didn't know a lot about the mechanics of corporate card issuing or sort of broadly corporate cards, purchasing cards, fleet cards, which are specifically cards that are issued for like truckers to pay for like fuel and stuff like that. And the mechanism is basically there is a requirement, the KYC, KYB requirement when you're onboarding to verify the company. But in this case, like let's say I'm onboarding Workweek, where Alex works. I am collecting documentation of the company and of beneficial owners or control persons associated with that company. So that could be people who own, generally the rule of thumb is more than 25% ownership.
Sure.
Or perhaps they have a specific executive position that gives them control over finance related things, CEO, CFO, whatever. But then to actually issue an incremental card, there's really, as I understand it, there is no legal or regulatory requirement. So Workweek can be onboarded to, corporate card provider X, go through the checks, whatever. But then when Workweek issues Alex a card, they're just spinning up a new card, and no one is really checking that Alex is a real person.
Sure.
That, any of the information we're putting to be associated with this card is even real.
Right.
And to be clear, like this wasn't, at least in my review, it wasn't purely like a small bank or a Bass Bank problem. I found cards and I found bins associated with Column, which is a fast-growing fintech infrastructure player. Crypto card as a service company is Rain, which Rain is kind of a weird one because it issues off a Puerto Rico-based money transmitter license, which is kind of a weird quirk of Visa MasterCard network rules that considers Puerto Rico to fall under LATAM network rules as opposed to like North America. But I also found cards from Fifth Third, which is a large, sophisticated player in the space, and Regions, which is a large regional bank based in Birmingham, Alabama. So it's not like strictly speaking a small bank or like a Bass Bank problem. Whew. Okay. That's the main story. Very quickly, also sort of relevant to stablecoin world. Separately, Bridge, subsidiary of Stripe, focused on stablecoin infrastructure.
Yep.
Folks are probably familiar. Also, recently had its application to form a national trust bank conditionally approved by OCC. So congratulations.
Did they get a big charter? Or we can talk about that later.
You're gonna trigger me, Alex. Bridge, as well as its parent company Stripe, were connected to a previous story you and I talked about, Contigo. Not clear if Bridge's decision to de-risk was related to Contigo, was related to progressing this trust bank charter, or something else altogether. But in the course of doing some research for various stablecoin stories, because I guess this is now the beat that I'm stuck on for the next year, I noticed that Bridge had basically moved a whole slew of ultra high risk countries like Russia, Belarus, Gaza Strip, South Sudan, and yes, Venezuela, from their categorization called controlled, which Bridge defines as not facilitating services except for specially approved programs.
Sure.
To prohibited, although hilariously asterisks, when you look at the definition of prohibited on Bridge's website, it says it will not facilitate services in these jurisdictions except in, quote, extraordinary situations. So that doesn't really sound to me like it's fully prohibited, but I guess, who knows what extraordinary situations is defined as. Now that I've given you my entire stablecoin monologue for February, the more I spend time looking at these stories in the stablecoin space, the more I feel like the huge unlock that everyone talks about is really just regulatory arbitrage and a lot of marketing hand waving. Is this just me being my regular cynical self?
No, I would have to say not. Or if it is, then you've converted me into being a cynic, which I think I always kind of was. And 2025, if I wasn't before, 2025 beat me into the shape of something that looks an awful lot like a cynic. I mean, I would say, well, first of all, can I just gently pitch you and our listeners on Stablecoin Hotel you can check out, but you can never leave, Jason? Is that maybe a good metaphor for this? We could play Eagles music when we bring up this segment in the future. I don't know. We'll keep.
Can we afford the licensing rights for Eagles music?
Maybe if it sounds like the Eagles, but it's not, and we
we have AI generate an Eagles knockoff. Done.
That's right. Yeah. Good point. We need to consult our lawyers, or at least our AI agents acting as our lawyers. Okay, so I think the thing that jumps out to me across all of this the most, and it's something we talked about with the Contigo story, and it's something I've been continually fascinated by, is it feels like the combination of nth party risk, which you've talked about, which is a third party that then has vendors that has other vendors that just sort of goes on and on and on, and sort of extends this infrastructure stack infinitely downward to the point where the company that ostensibly maybe has some form of obligation to regulators to uphold laws like whether it's economic sanctions or money laundering or what have you. I think that nth party risk combined with this instinct to sort of find product market fit. And I wrote a piece about this actually in my newsletter about the ways that product market fit sort of trick founders, or founders allow themselves to be tricked by, combined with the sort of inherently decentralized and sort of uncontrolled nature of crypto is kind of a perfect storm for these kind of problems, right? Because obviously, crypto to be useful in the real world has to touch real banking systems, right? It has to touch real payment rails. This is why cards are such a popular form factor, because cards are accepted everywhere and so on. But I also think that if you can find a way to keep the thing that's touching the regular banking ecosystem as tangentially touching it as possible. And I think cards are a good example, program management. We don't really have to do KYC on all of these employee cards underneath this from a KYB perspective, to use your loophole. Well, then it's and this goes to the advice that these cards programs give, or these warnings, hey, just don't get us in trouble with disputes. And I noted this with the Contigo thing. It's like the problem is not disputes. The problem is disputes throwing the covers back and then me finding that there's a bunch of scorpions in this bed. Like that's the problem. The scorpions are the problem. It's not, that weird clicking sound that I'm hearing. And I feel like it's indicative of the challenge of financial crimes enforcement fundamentally being so disconnected from the infrastructure that's used to enable this. And, I don't know, Jason, I mean, you probably have had more direct feedback or conversations with some of the folks that operate in this space. I have a hard time telling like how much of it is done sort of naively in good faith and how much of it is just like crime pays. It's a very hard balance to strike, right? There was a great statement that was put out by, was it Uncash? Was that another one of the providers in this space?
Uncash, yes.
And their statement was like friggin' amazing because it was like, I think it started with, "It's over. Thanks, MasterCard." And then it said, "We regret to inform you that MasterCard, in all of its infinite wisdom, has decided that our card issuers need to be shut down immediately. No discussion, no appeal, just a clean corporate guillotine." And it's such a funny statement because Jason posted about it on LinkedIn if you guys want to go read it. It's such a funny statement because it's like both like willfully like giving the middle finger to anyone who has any like role in enforcing any of these rules, which these guys clearly like philosophically don't agree with, while at the same time evincing like a naive view of how infrastructure works. Like they go on to sort of say like, we kind of thought we could do this, but apparently all of these rails run through these centralized actors, and if they shut us down, there's nothing we can do. Like, you didn't know that before you started doing this, and so it's this very strange combination of like either sort of philosophical disagreements with certain laws or regulations combined with maybe sort of a lack of awareness of criminal activity or an open tolerance of criminal activity or a courting of criminal activity as a set of customers, combined with this just sort of naivete that you tend to see among fintech and fintech adjacent founders, especially their first couple go-arounds with corporate guillotines. And I find the whole combination to be, I mean, as you said, these no KYC cards have existed forever. There's always been a market for it, but it does seem to have been supercharged by crypto's decentralized nature technically, as well as its like philosophical like, fuck you, you don't get to tell us to not operate in Venezuela. And I mean, it kind of ties back to your bridge example too. Like, it's shocking to me. There was a episode of the Stripe podcast, right? Cheeky Pint that
oh yeah, you're going exactly where I was about to go.
yeah. And just to tee you up for that, I mean, It was, I listened to that podcast. I know you did too. And it was weird hearing like Zach at Bridge and which Collison brother was it on the podcast?
Patrick.
And hearing them talk about Venezuela as like a market opportunity and a growth opportunity with seemingly no, I couldn't tell, cares or no awareness. I couldn't tell, but it's like they were saying Venezuela as if Venezuela wasn't a comprehensively sanctioned country that a lot of other companies stay out of, not because they don't recognize there's people in Venezuela who want your services, but because legally it's so difficult to serve them that they just don't bother. Like, it wasn't clear to me if they understood that.
I actually had to listen to that podcast twice and read the transcript or read relevant portions of the transcript because I was a little bit flabbergasted. It's like, if I keep hammering on this, by the way, I probably will get debanked from Stripe at some point because I do use Stripe. Yeah. But set that aside.
Happy Stripe customer here.
I'm a very satisfied Stripe customer. Yeah. I find it incredibly difficult that somebody as smart, totally. Intellectually raw smart, as well as somebody who's been running a company in the payment space for however long Stripe has been around, 10 plus years at this point, is not aware of the risks and regulations that, are involved in moving money in and out of, moving money, period, but particularly moving money in and out of countries that are facing some level of sanction or other kinds of controls, which Venezuela is. I mean, the example, what really struck me about the episode of the Stripe podcast you're talking about was the examples they gave were Venezuela, Colombia, which has a major narco trafficking, and by extension, money laundering nexus. And I think Rwanda, and there may be a couple of other countries I'm forgetting. And again, I don't want to like rehash the same conversation we had when we talked about Contigo, because I got some of this bubbling up on Twitter after publishing the stuff on Bridge, where it's like, why does the global north automatically assume any country in the global south is high risk? And it's like, I mean, I'm not sure I want to engage with that particular statement, but if you can look at a specific set of facts on the ground and a specific set of policy choices coming out of the United States or the EU, and I'm not saying that I agree or co-sign those policy statements, but again, two things can be true at the same time. To listen to that podcast, and I think you're framing it correctly, to have the frame of the discussion be, this is a market opportunity. It's like, yeah, if no one else is going to bank you or give you access to dollar rails because New York Times headline today about Binance moving billions of dollars worth of funds into Iran. Or if you're, affiliated with the government of Venezuela or the Venezuelan state oil company, which is sanctioned, there's essentially infinite demand to have access to or move dollars. And so if you are willing as a company to take the risk of serving that demand, of course, the chart of all of your numbers are going to go up and to the right. Of course, you can charge, crazy take rates to serve that very high risk demand. But then you can't be surprised if you're an end user of those services, whether it's the no KYC cards or there's all these sort of stablecoin powered neobanks that have sort of varying degrees of grayness in how they operate. You can't be surprised when that stuff gets abruptly turned off. And if you've built, if you're that freelancer in Venezuela or Argentina or wherever, and you've built your sort of personal operating life around having that access, but it's not reliable, then is it really solving the problem that you need to solve? If it can get frozen, if it can get taken away at sort of any point in time based on Bridge's risk tolerance, based on a regulatory enforcement action. But I find it incredibly difficult to believe that Patrick Collison and Stripe do not understand the risks they're taking. I think that I'm projecting or assuming that the calculus is that the financial rewards right now at this point in time justify those risks. And that calculus may change in the future. And remember, the regulators are backward looking, and you don't know who will be in office, who will be at the OCC, who will be at FinCEN 4 years from now.
Well, it's a great point. And I think just to add one more thought to it, would they have moved those countries that you mentioned to the prohibited list if not for your reporting and for the reporting from other folks like at the Information? Like, to me, that's one of the most important questions to sort of ask about all of this is, again, because of this nth party risk and because of all of this infrastructure where everyone can kind of credibly say, well, we don't think it's money laundering. We don't know because we're not the ones monitoring all the individual transactions. That's some other company that you've never heard of that doesn't have a regulator to answer to. We just talked to their program manager, and their program manager hasn't mentioned anything about any sanctioned countries. And we just process transactions. And as long as there's not too many chargebacks, we're not in violation of network rules. So we're fine. It's not clear to me. This is the thing I worry about is it's unclear to me in this model that's so decentralized where there's not like a bank sitting at the very center of the bottom of this stack, it is not clear to me whose job as a regulated entity it was to stop this from happening. And it's not clear to me that even if we had regulators who cared about any of this right now, which we don't, but if we did, would they have been able to find this? Would they have been able to stop this? That's the concern about the combination of decentralized blockchain technology combined with nth party risk, because it's not clear to me that regulators, even if they were paying attention, could have found this. And that absent your reporting and the reporting of others, I don't know that these things would have come off of the block list. And that to me, when reporters are functionally acting as regulators for the purposes of making sure that sanctions or anti-money laundering rules are adhered to, we have a structural problem that's much bigger than any one company.
Speaking of regulators who do not care, should we squeeze in your favorite topic for 2026?
Yeah, let's just do this real fast. So prediction markets are the one that I can't let go of. And I will do sort of an extended soliloquy here, Jason, if you'll just give me 1 second. The update here, there's two. And I think the second one I actually want to end on because I think it's very relevant to you as a content creator. But the first one is our friends at the Commodity Futures Trading Commission. And by friends, I basically mean one person because the CFTC, while normally a body that has 5 commissioners, now only has one commissioner, the chair, Mike Selig. And during his November 2025 nomination hearing, he told the Senate that he would defer to the courts on the issue of sports betting and prediction markets, which is the issue that's made sports betting and prediction markets so controversial, is basically prediction markets using the fact that they are regulated as commodities exchanges to bypass all state regulation around traditional forms of sports betting, which the Supreme Court legalized, but only on a state-by-state basis. So if you're a state like Utah and you say, we want people to go to church on Sunday and we don't want the young men at church to be betting on live NFL games while they're in church, that feels like a very reasonable position to me. And that is functionally, in some senses, what Mike Selig said. He said, look, this is not for me to determine. This is a question for the courts. Okay. Well, early in 2026, not that long ago, actually, he reversed his position and is now asserting the agency's exclusive jurisdiction over prediction markets and has taken steps to actively defend these markets in filings of amicus briefs against state-level prohibitions, specifically, again, not targeted at prediction markets generally, but at sports betting. This has made him enormously popular with the two largest prediction markets, Kalshi and Poly Market, as you might imagine. That probably has nothing to do with the fact that Selig's boss's son is an advisor to both Kalshi and Poly Market. I'm sure that's unrelated. And it has also created a very interesting political fracture, I guess, within the Republican Party, because immediately after this happened, Spencer Cox, the current governor of Utah, and then shortly after Chris Christie, the former governor of New Jersey, both came out in strong opposition to Selig's defense of sports betting through prediction markets. And I find that really fascinating, actually, because normally you tend to see these types of regulatory issues sort of draw pretty clean lines between Democrats and Republicans. I would say crypto, in a more general sense, sort of became kind of a issue that Republicans got on board with and that Democrats, at least some Democrats, continue to oppose. In this particular case, I don't know, Jason. I mean, I guess my assumption is that Republicans in Congress, being champions of states' rights and small government, will immediately advance legislation to curb the CFTC's dramatic sort of federal overreach. Do you think that's the most likely scenario here?
I do not think that that's the most likely scenario. It feels again.
You wouldn't bet. You wouldn't bet on that in Kalshi.
I would not bet on it.
Okay, all right.
I mean, it feels like a replay of crypto, right? Where it's like at the very beginning, there's some confusion. Do we like this thing? Do we not like this thing? What side are we on? Why? I mean, I suppose there's some differences in the sense that, you have certain states, you mentioned New Jersey. I'm not familiar with Chris Christie's, what his specific argument is, but states that are losing tax revenue associated with gambling or associated with
New
sports
Jersey's
betting.
A big one for sports betting revenue. They got into sports betting early, and I think they view Kalshi as taking money from their coffers, basically. Yeah.
Well, I mean, which is not an economically irrational position. So it's okay, there's that view. There is, I'm assuming the Utah view is, as you described, more grounded in I know this is quaint, but morality and a moral opposition to sports betting or to gambling.
Governor Cox's comments very much were like that. He basically said this is ruining the lives of American families, of Utah families, and in particular is ruining the lives of young men, which I think is a very well-informed critique of who uses these services and who misuses these services. So he is, I mean, credit to him. I think he's making a very strong moral argument. And that's why Utah hasn't allowed any sports betting, right? Is that they don't believe that it's in the best interest of their citizens. And, their citizens, again, it's not irrelevant to the situation we were just talking about with stable coins and no KYC cards. Like, it is not the right of corporations to decide that they know better than the elected representatives of these different jurisdictions, right? So like, you might not agree with the idea that we should have economic sanctions on Venezuela, and you might even see the harm that causes to individual consumers or small business owners in Venezuela, but it is not your job to make that decision. We did not elect you to do that. You don't get to just ignore that rule. And I think the same thing applies with Kalshi and Polymarket. I mean, they view it as overreach by all of the states, including the state of Utah, to restrict 19-year-olds' access to sports betting. But like, I don't remember myself or the citizens of Utah voting for Kalshi to make that decision. So it seems relatively absurd. And I strangely do find myself on the side of states' rights, which is not a side I often argue. But in this particular case, I kind of find myself being sympathetic to that argument.
I mean, I think it is the latest example of this sort of like late stage, Silicon Valley, quote unquote, innovation, where the primary innovation is how do we do regulatory arbitrage to extract money from people in a way that 1 or 2 or 3 or 5 years ago, pretty much everyone agreed was like categorically and obviously illegal.
Yes. Yeah. I tend to feel that way. And it's just, it's a sign of the times, I guess, that we are headed into what it seems to be is going to be a boom market for prediction markets. 2026 will be the year. And I guess we will see Governor Cox in Utah vowed very publicly in response to Mike Selig's video that he posted that, essentially we'll see you in court. And so I'm not a lawyer. I won't opine on the legal merits of each side's argument, but we will see this play out in pretty dramatic fashion. Jason, can I just end with one other prediction market story that I'd like to get your take on super fast?
Yes.
Okay.
Yes, you can.
You write the wonderful Fintech Business Weekly newsletter on Substack. I am very excited for you because Substack has announced a partnership with Polymarket to embed prediction markets into Substack because, and I quote, journalism is better when it's backed by live markets. Now, a couple quick thoughts on this. One, Polymarket makes by far the most sense as a choice here if you are concerned about journalism, because while it is historically operated as sort of an offshore, crypto native, very unregulated prediction market, not that any of the markets have been that well regulated, but Polymarket's the one where they don't really care who you are. They don't do KYC. They importantly do not take insider trading all that seriously. So if you're an insider, go to Polymarket and you can bet on whatever. In fact, this month, Israeli authorities investigated and arrested military reservists and a civilian for using classified insider information about sort of Israeli military plans to place bets on Polymarket. The bets allegedly concerned, again, future Israeli military operations, raising serious security and ethical concerns regarding the use of sensitive, non-public data for personal financial gain. It's fascinating because, there's a journalism question here. Traditional news organizations are frequently asked by governments not to disclose sensitive military operations because doing so would place people's lives in danger. What does embedding a tool that encourages insider information and can be easily manipulated by anyone into a platform for journalists do to journalism? I ask this of you, Jason, a Substack user and journalist who I very much admire.
I hate all of this. Is the short and honest answer. I certainly know that Substack is not the only sort of platform or traditional media outlet. CNN CNN with Kalshi, and somebody else is also partnered with Kalshi.
Yeah, everyone is. This is where the money is, man.
I mean, I'm not familiar with the specific terms of any of these deals as far as like if money is changing hands between Polymarket, Kalshi, and like Substack, which like Asterix, who's a major investor in Substack, A16Z,
got their fingerprints all over this stuff.
Or if there's some compensation flowing to CNN or any of these other news outlets. I mean, it to try to be a little more charitable, like, can these prediction markets be a source of information, the wisdom of crowds, etc.? Yes, I do think that there's demonstrable historical statistical validity to that.
Yeah.
Do I think that having the ability to bet on whether or not Bitcoin goes up or down in the next 5 minutes offers any informational value? No, that's only for the degenerate gamblers that are like, to reference our Utah governor, potentially ruining their lives by becoming addicted to gambling on these platforms. And then, to your point, like, where are, as a society, as a government, where should these ethical and moral lines around how access to information, how you're able to use access to information that you have that other people don't have? And I know that you worked in financial services. I'm not sure if at FICO or Cornerstone you would have had the kinds of trainings that I had to sit through every year on, like, Foreign Corrupt Practices Act. And
I really didn't. I got to avoid most of that.
Yeah. So it's like, I'm joking, but particularly at Goldman, given the nature of the businesses Goldman is in, like, this was beaten into your head, even internally. And I'm kind of surprised that they used this term because it feels like it's not PC, but internally within the firm, there was the public side and the private side, and even sending emails, there was a quote unquote Chinese wall between different parts of the firm to regulate how information was shared internally due to concerns about even internal conflicts of interest or internal misuse of information that you shouldn't have access to. And I think that, like, these kinds of Polymarket and Kalshi, insider trading stories just demonstrate, like, a real, if not immorality, then amorality. Like, essentially that, like, there is no moral universe apart from maximizing your own personal wealth. And I think that leads to, like, a pretty dark place pretty quickly.
Yeah, that's how I feel. And I think that mindset, I use the example of, kind of traditional media companies sort of like applying the lessons or the ideas of journalism with, like, a practical and moral framework wrapped around it, right? Like, yes, we want information to be free. Yes, we view the role of journalism as the fourth estate and holding power accountable very important. But if someone comes to us and makes a credible argument that someone's going to get hurt, we are willing to not maximize the free flow of information and assert the most sort of aggressive version of our constitutional rights in order to, like, make practical considerations, the fact that, like, we're trying to help people, not hurt people. And I feel like in this sort of, like, techno-libertarian code is law, everything is allowed ecosystem and culture that we're in right now, we are losing that ability to make those kind of practical and moral distinctions where it's like, yes, I agree with you. Like, prediction markets, well regulated in certain use cases in certain domains, has a huge informational value that should be incorporated into Substack and should be added to these other places and should be relied on by economists and political scientists. Like, it's a neat tool, but it is not a tool that comes without any risks or harms to society. And just listening to the way that Kalshi, Polymarket, Donald Trump Jr., and Mike Selig talk about it makes me sort of despair for our culture and our society. And I can't wait, Jason, to be sort of the embedded reporter that you come to on prediction markets on a monthly basis this year, because I'm probably not going to have super cheerful things to bring you.
This is like a time capsule, and somebody's going to go back and listen to this, and you and I are like the two cranky old men, like bemoaning the collapse of society. Hopefully, we're wrong.
I hope so too. Jason, I feel like that was a pretty good collective can't let it go. If you are good to not heap any more annoyance onto the shoulders of our audience. I can't wait to truly do this podcast with you again next month. I'm sure many good things, both good and interesting and bad and vexing, will happen between now and then. But thank you, sir. This was awesome.
Until next time.
Okay. Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.